Well, guys, wrapping up another week and another week at all-time highs. My name is Hamilton. I'm here with the Trading Initiative, and in this week's Markets in Focus, wrapping up the week, finishing March 1st, we're going to dive into the good, the bad, the ugly, and quite possibly the best stuff ever. Let's just dive right in. Let's go ahead and start with our intermarket analysis here. We're looking at the most important assets in the actual market and how they performed over the last week. Is there a bigger story than Bitcoin right now? Bitcoin. Up and over 60K. We had the highest monthly close on a candlestick in Bitcoin's history. Monthly close. Guys, if you are a technical trader in any regard, this is the beginning of the next breakout into new all-time highs. We've been long Bitcoin since above the 200-day moving average at 27 or 28K. We've been cautiously bullish for a majority of the last 6 months-ish. Really going back to October is when we ramped up our exposure. That was the right call. And we don't think that this is going to be ending anytime soon, regardless of the halving or not. If you look at Bitcoin's price history, these super cycles tend to last for anywhere between a few quarters to potentially up to a year or two. And we do think that a breakout into all-time high is the next beginning of a leg up in Bitcoin. It's a very exciting time to be long crypto. And if you're not long crypto, I'm not openly endorsing going and YOLOing your entire 401k, but it's a fantastic opportunity for some super volatile trading. And the primary trend is up, right? So Bitcoin up over 20% on the week. Congratulations to those of you that were in it. But small caps, let's talk TradFi, small caps. Finally, guys, the Russell 2K is showing us a little something. We're finally breaking the range, currently trading north of 200. This is very constructive price action in a market that has seen small caps underperform over the last 2 years. There's been bits and pieces of overperformance, but for the most part, they have underperformed. And finally, they're breaking out, finally showing that they want to join the party. That opens up an entire new type of environment of trading, an entire new universe of stocks that we could potentially be buying. We are super stoked to be getting long small caps, and we are. We're going to go through two of those names later on in this video. Q's as of right now up 2%. The S&P 500 is up 1%. Nearly everything is up, guys. This has been a fantastic week once again to be long because we are in year 2 of a cyclical bull market, and there's no reason to be looking too short anything with any sort of size. Now, I do want to preface this video with we were slightly bearish in February. Seasonality kind of told us to be careful. There's some intermarket relationships that we're starting to break down. We did buy puts as some hedging type of activity. We got out at about a 50% win rate on that, which I'm surprised. I expected actually to lose more than that. So we got lucky on some of those breakdowns and things like JKS. We got breakdowns on things like MOS, but then we also got burned on things like the Chewy short that we grabbed. We got stopped out near break even. Some guys got a minor win. Some guys got a minor loss. So we're going to call that a break even trade on just some index puts on the Qs. I think I'm missing a couple other ones, but all in all, we didn't really lose any money hedging through February. I'm super stoked on that, but we were prepared for a pullback, and it never came. We're now on the other side of that. We got to trade what's in front of us. If you're still bearish, guys, all-time highs, everything is screaming to the upside. If you don't have long exposure, you are going to be playing a very tough game of catch-up starting basically today. As we see in a second, a lot of the most important areas of the market are breaking out into all-time highs, and it looks like a gap-and-go situation. So be very careful. If you don't have long exposure, you should really be building a watch list on names that are breaking out here because you don't want to chase. Let's go to U.S. sector performance. So we're going to start using the year-to-date tab here instead of 3-month because now we have enough data going back to the beginning of the year to where now we can finally start looking at what are the yearly trends here in 2024, not necessarily things that were going on in 2023. Comms up the most. Comms are up the most. Being led by what? Meta. Meta's up and over $500. We still have some sporadic positions in Meta right now. I think our biggest win on Meta is up 1,250% and up and over 60 grand as a total on that trade. We've made more money in Meta, I think, than most other tickers going back about 12 months now was our first entry in Meta back in like February, March of 2023. Congratulations to Dustin, the big winner there. I think he's going to end up bringing in over $130,000 on the Meta trade by the time he's done. Closing all of it. He does have March expirations. That means he is very, very close to getting kicked out of that trade regardless of whether or not he wants to stay in it. So good job being able to hold a core position in that Meta trade all the way up to basically the end of the trade. Dustin, if you're listening to this, that's a huge win for you. But tech up 10% this year. Right there, being led to the upside by semiconductors. You would think it's software. You'd think of names like Microsoft and Apple. And although Microsoft has been doing well, Apple is actually trading below its 200-day moving average. What the hell is going on with Apple? I have no idea, but I do know that semiconductors are actually pulling software up, not the other way around. which is, what we saw in 2023. I don't know why anybody would expect anything different in 2024. All eyes right now are on semis and tech in particular. SPY's up 7%, healthcare up 7.21, financials up 7.19. We have industrials up 6.51, and then we have a noticeable fall off in performance. So if you've been following any of our content, you know that we're majority long communications, tech. We have some healthcare exposure and we have some financial exposure. There's a reason why we don't have any exposure long to really any other sector, and it's because they're not outperforming the benchmark at all. Not even close, as a matter of fact. The closest one is energy, up 4%, and that's still down nearly 4% from the benchmark. Guys, inside of TTI, we don't buy things going up. We buy things going up faster than the benchmark. We want the strongest of the strong, the biggest outperformers. And as of right now, communications, tech, financials, healthcare, and to a certain degree, industrials, although industrials have, it's a harder trade. That's the area you want to be focused on right now. And so if you're following our content, you already are. Let's get the industries here, on the year-to-date chart. Surprise, surprise, semis just absolutely blowing it away. Guys, this is a second-year trend now of semis outperforming. This is probably not going to end. The AI bubble everybody wants to burst is probably going to continue to run for quarters or years. If you go back to the dot-com bubble, look at the previous video I made on this. Is the AI bubble going to burst anytime soon? Probably not. Statistically speaking, it's not going to. Semis are probably going to be a very, very good long trade for quarters or years to come. That's not to say that they're just going to go straight up all the time. There will be pullbacks. And obviously, the more crowded these trades get, the more volatile they get. But bubbles can last a hell of a lot longer than most people expect. And there's an incredible amount of money in the system that's sloshing around right now. So once people start to catch on to a bubble, which I think most people are, it starts to feed on itself as a positive feedback loop. And that's what causes the bubble to actually expand and catch velocity. So if you can catch these semiconductor trades at near the beginning of the bubble, which right now we're only on year 2 of a cyclical bull market, and realistically, many of these semiconductors outside of NVIDIA and SMCI are not superly blown out of proportion. Look at them. Even AMD, which is something we're going to go through in a second, has room to continue to run. It's crazy to think about, and we have positions in those. But here we have semis. Once again, you really want to be focused on the names or parts of the market that are either out-competing the benchmark or are in somewhere around the benchmark. Right now, we have semis up 28%, 26%. We have internet names up 10%. Now, the benchmark's at 8%. Software is up 7%. A lot of that is because Apple is underperforming. But realistically, the name of the game right now is to be long. Tech, comms, growth. That's where all of the outperformance is. And you probably know that if you've been trading. So continue to trade those areas. There's no reason to deviate from that. There's no apparent top in place yet. That's where all of the money is flowing. As a matter of fact, if we look at factor analysis on the year to date, we can see right now that large cap growth is outperforming everything by a very large margin. Think of your NVIDIA, think of your SMCI, think of your AMD, right? Your semis, your Microsofts, your Ubers, all of these large cap growth related names are just absolutely blowing everything out of the water, outperforming the S&P 500 by 3.54%. Guys, from a trading perspective, focus on the leaders. And the leaders right now are large cap growth, and to a certain extent as well, mid-cap growth, right? We don't have to reinvent the wheel. You don't have to go find new trades. Just go and filter through these specific areas of the market. You can whittle down that 9,500 available option universe on any scanner to something like a 200 to 300 scanner with really nothing other than just looking at sector and market cap, and then you can get into specific setups. So once again, guys, we want to be long the growth areas. We want to be long the larges and the mids, and to a certain extent the smalls now that the Russell 2K is starting to break out. And that's all I got for you for CoinFin. Let's get to trading view. This is the stuff. Let's actually get in, start charting a little bit. First things first, let's look at the S&P 500. If there's some nasty drawings on here from me explaining things over the last few webinars I've run, I apologize. I haven't gone through and cleaned any of the charts yet. But guess what? We're halfway through the metered move. We're halfway through the metered move, guys. This is an all-time high breakout in the S&P 500 that was confirmed at the beginning of the year, and it's doing exactly what all-time high breakouts tend to do. They tend to keep breaking out. Trends tend to trend longer than most people expect. If you've been net short all year, you're a fucking loser. There's no other way to put it. We're halfway through. Once again, I don't think it's just going to go straight up. I definitely think there's going to be an opportunity for some sort of pullback, but I also said that in February. And we really didn't have a pullback whatsoever. So it's very important that if you're long, you don't stop out and try to time at the top of a market, because I thought we were going to have a pullback in February. But just because I thought there was going to be a pullback, I did not close all of my longs. As a matter of fact, if you've been following any of our content, we are very long, and I'm going to show it to you shortly. We don't close our longs if we think there's a pullback. We'll buy hedges and we'll stop out intelligently, but we don't want to get out of winning positions just because we think something's going to happen. We want to get out of positions when it is happening, when something that we've set up on the trade idea happens to stop us out. that's when we stop. Once again, we're halfway through the metered move. Is it insane to think that we could be at 550, right? 550 by the end of the year? I would tell you, no. I think it's crazy. We're near 515 3 months in. But once again, my opinion doesn't mean shit. It's just how we interpret the market moves. Trade with the trend. The trend is up, right? So halfway through the metered move in SPY, it's absolutely bonkers to me. The Qs are even better. The Qs are up over their 50% move. We are expecting near $500 in the Qs. Is that reasonable to expect to happen this year? Yeah, absolutely. Is it going to happen tomorrow? Probably not. Is it going to happen over the next month? Probably not. But this is a fantastic breakout continuation run into an all-time high. Why would you expect anything else? You can see that we were expecting the pullback, potentially an undercut. Maybe it still happens. I have no idea, but we're not prepared for it yet if it does. We have closed all of our puts. We have no hedges in place because the market is screaming at us that it doesn't want to continue to go down. There's intermarket relationships and momentum indicators have reset and started to oscillate back to the upside. All right, hands off the puts. There's no reason to be afraid at this point right now. With the trends as strong as they are to the upside, the Qs are up and over the 50% move. Do I think it's going to go straight up? No, I do think it'll eventually pull back. But I think that by end of year, 500 or close to it is well within reason for the NASDAQ 100. Why wouldn't it be? Look at IWM. This is a 2-year high for all of you that have been patiently waiting for small caps to finally join the party. Hello, they are finally here. Small caps are finally breaking out. We're seeing it in our scanners. There are an incredible amount of stage 2 breakouts that are on our scanners every single day, and we're in a bunch of them. Why? Because the stage 2 breakouts in smalls and mids were some of our biggest wins in 2023. Why the hell would we not expect them to also be the biggest wins in 2024? Now that the Russell 2K is breaking out of a range into 2-year highs, guys, play the smalls and mids as they come up. You don't need to reinvent the wheel on those setups either. Find the easy setups, the layups. You don't need to go and buy a name with a shit ton of overhead supply. Find the clean, easily readable, horizontal level breakouts with a rising 200-day moving average. I'll show you one in a second. And just buy the fucking breakout. It doesn't have to be super hard. Let's look at some of these equal weighted ETFs because people like to say breadth sucks. Yes, I understand. There's narrowing leadership at the top. People are worried about it, whatever. This is the equal weight S&P 500. Meaning Apple, Microsoft, NVIDIA in particular to this ETF weigh the exact same as the bottom 5 companies, right? There's going to be no difference in weighting in terms of the biggest companies versus the smallest companies in the S&P 500. And we are about 2 days out from an all-time high in an equal weight ETF. So once again, if you want to bitch and complain about breadth, feel free. That's totally fine. But at this point, your view is wrong. And that's fine. We've been wrong. I was just wrong about the February drawdown. That's okay. You can still make money being wrong as long as your ego's not involved. The S&P 500 equal weight ETF RSP is a few days away from all-time highs, showing that market breadth is not as bad as what most people think. And as a matter of fact, if we look at equal weighted Qs, that's a big middle finger to bears. That is an all-time high in the equal weighted NASDAQ 100. So for those of you that think it's just NVIDIA, it's just the mega caps that are moving, the Mag 7s, this is telling you right here, it's not. It's the entire NASDAQ 100 that is moving up into new all-time highs. This is an equal weighted ETF. That's how these things work. Market breadth looks great. Be long. The dollar, arguably the most important chart in the market because the intermarket relationship between the dollar and the equity world, right? Inverse. When the dollar tends to move up, the market at the very minimum tends to move a little bit slower, tends to be a little bit more cautious. As a matter of fact, all of last year, we were able to rally because the dollar stopped moving up like it did from 2021 into 2022. This was bear market territory. The dollar gained strength and the equity market didn't. Then the dollar started to consolidate. The market took it as an opportunity to zoom up into all-time highs. And obviously, this was during the corrective phase. If you see, this was the corrective phase of last year from July through October. The dollar caught a bid. All of a sudden, the market said, whoa, chill out. And then all of a sudden, the market topped and came back down. And guess what happened year end? We hit new or damn near all-time highs in the indexes. Well, since the beginning of the year, we have seen the dollar gain a little bit of strength here, but still hovering around the 200-day moving average. And the market right now, at least the way that it's trading, looks like the dollar is going to break down. I mean, that's what we think it is. We're not taking active shorts on the dollar. There's no reason. Being long stocks is effectively the same thing as being short the dollar with this inverse relationship. But we do think that if the dollar breaks back below the 200-day moving average, which it very well could relatively soon, there's going to be more tailwind to stocks. Imagine that. More reason to be buying stocks as smart money investors, financial institutions realize that holding dollars in an environment where the dollar is going down it's not a very good return. And so they're going to want to park those somewhere. Where do they want to park them? Well, stocks are going up. Why wouldn't stocks be a good alternative, right? I would assume that if the dollar breaks below the 200-day moving average, stocks are going to catch even a bigger bid. Bonds, second most important chart in the market. We've been talking about in TTI, if this breaks below 92, it's watch out mode. Not necessarily get out of everything, right? Once again, we don't want to stop out of things prematurely. We take stops based off of predetermined spots on the charts. If you're a technical trader, I highly encourage you to do that as well. Try not to deviate from the original plan. But obviously, if you look back, a year and a half, this 92 area in bonds is an important area. Now, why do bonds matter? Because bonds are, or have been, at least over the last 18 months, positively correlated to the market. So if you think about the dollar, every time the dollar went up, market went down. Every time the market went up, the dollar was going down. So it's an inverse relationship. Well, with bonds, which is, by the way, very different than it's been for the last 30, 40 years, when bonds were going up over the last 18 months, so were equities. And when bonds were dying, so were equities. So we have a positive correlation between bonds and stocks. You can see during the bear market, TLT sold off. This is why the traditional 60-40 portfolio had its worst year ever in 2021 through 2022. Now, I have to ask yourself, has that intermarket relationship broken? We don't think so. There's not enough evidence to say that it has. But it has diverged this year as bonds have sold off and the stock market has obviously shot to new all-time highs. But as of right here, we said below 92, it's probably watch out for stocks because we still think there's a positive correlation between bonds and equities. But for right now, TLT held 92 and is actually starting to reclaim new highs. Was that the end of the oscillation low? We think if, just like the dollar breaking below the 200 being positive for stocks, we think bonds breaking above the 200 would be positive for stocks. And both of those things look like they want to happen as early as next week. If that happens, game time, baby, more tailwind. Tech, all-time high. This was our original price target off of the all-time high pivot near 177. We were targeting 215. We don't have a specific trade on XLK, but we are very long tech. Why would you not? We're not dumb. All-time highs are great. We're about a stone's throw away from all-time highs. Congrats to those of you that have been able to hold your tech shorts, not getting stopped out from doom and gloom perma bears on financial media outlets, FinTwit, YouTube. YouTube is notoriously bad, by the way. Look at how many stupid fucking thumbnails come out. Watch out, the end of the world's coming, literally every other video, and then their video is just complete trash. It's just their opinions and has absolutely nothing to do with real life. Like, it's just fucking garbage. Anyway, semiconductors, all-time high, up 4% today. Hello, this is a bubble, guys. George Soros told us to trade into the bubble. People are dumb. There's always a greater fool. Don't be the last asshole holding the bag. But if you're the other side, if you're an asshole and you're ornery and you don't want to take the trade, guys, you're going to miss out on potentially, and I mean this sincerely, life-changing money. I'm being serious. Bubbles can serve a purpose on both sides of the equation. You can go long into the front side of the bubble and you can short on the back side. The people that get screwed are the guys up here. If you have a couple brain cells, you're following this channel. Hopefully you do have a couple brain cells. You realize that AI bubbles can last, or not AI bubbles, but bubbles in general can last quarters or years. This is the beginning. This is the beginning. Once again, go back and watch the .com bubble video I put out. Who knows where semiconductors are going to be in 2 to 3 years? If they continue to rise, are you just going to continue to short, or are you going to continue to sit on the sidelines, guys? I implore you, find strategic entries into the hottest industry group right now and take a leap of faith and watch what happens. We have been doing it for the last 6 months now. November, I guess 5 months now. Since November, we've been long semiconductors because it was the leading industry group of 2023. Why would that change into 2024? Surprise, it hasn't. Guys, this shit matters. Speaking of semiconductors, AMD. We have been long since here. We added in here, and we added in here. As a matter of fact, because I know most people are going to be like, no, there's no way. There's no way you got that lucky. I don't know if it's luck as much as it is. We've just been doing this a long time. It's the hottest industry group in the market right now. Let's talk about adding into winners, right? So I'm going to show you the actual trade idea where we added into AMD, if Circle will load, because Circle is our platform that we utilize to disseminate all of the information that we put out, all of our trade ideas, all of our daily newsletters that we put out. We go ahead and show it to you really quick. Here it is, an updated advanced micro devices entry. So we've been in a position in AMD going back to the beginning of November, right? So this is our third entry, and per Dom, who's a member that's been with us for 3 years now, this is the guy that has been featured in a lot of our content. He grew his account by 127% last year, so shout out Dom. He came up with a new ad on AMD, and so we put it out. We said, go ahead and add into the AMD consolidation fractal up and over the resistance area into all-time highs if your original position is already risk-free, meaning we've closed half at 100%. Most people did. Here is the actual play that we added in on, the 230 calls for no more than $7, or if that's too expensive for the individual, the 220, 230 call debit spreads for no more than $2. Max return 8, because we don't buy anything under 4-1. We understand that math matters a lot. And guess what happened? Obviously, that was 4 or 5 days ago we added, and we get the big gap up. So once again, not sitting here screaming, you need to go own AMD. But guys, this is a leading industry group. This is it. If this is actually a bubble, which I don't think it's not, I think it is, you need to find a way to participate in it. And if you can find consolidation fractals in a stock that is showing leadership qualities, you should be looking to buy it. Buy it, buy it, buy it. Speaking of leadership qualities, look at ARM. Here's another name. Yes, we've owned it since right here. We've made lots of content on it. We added here. We added somewhere in here. And obviously, we're actually looking to potentially add again on a new breakout, which we think is going to happen. But we haven't added yet. This is a huge win for us. It's up over 2,000%. There's no reason to expect this not to continue to run. It might be chilling out here. Think about the financial institutions that this big power earnings gap got interested, and now they're looking to accumulate a position before ramping it up. This is normal market-leading characteristics as financial institutions look to accumulate shares post-power earnings gap before a continued ramp to the upside. We expect ARM to be closer to 190 over the next 2 to 3 weeks. Then, back to $100. So once again, this is another semiconductor name that we've been in since November. We bought back here in November, the IPO range high breakout, leading industry group, guys. You got to do this. Uber, this is a name that we've put out in our newsletter. This is a name that you guys that are watching this are probably trading as well. Multiple entries here, but the last entry was this 64 area all-time high breakout. Guys, if you're afraid of buying all-time high breakouts, I'm going to tell you something. In bull markets, which generally the market is in, more often than not, you're going to miss out on incredible opportunities to find exposure in leading stocks. I'm not telling you that it's the absolute best entry point, but you know where you're right and you know where you're wrong. If you buy north of the all-time high, you know that if the stock continues, you're probably in the right type of stock. If you're in at all-time high and all of a sudden it gaps down and you realize, shit, maybe it's not going to continue to go up, you cut it. It's a very easy risk-on, risk-off method. We bought 64. We added into 64, actually, because we've already been long Uber for the last, almost 12 months now. And here we are. We're expecting a continuation breakout here with dwindling volume in a consolidation fractal with $95 as our profit target here. We have $80 calls, so we're in the money on these, and we have another 5 months of expiration on this. So once again, if you're trading Uber, congratulations. This is a 300 to 400% win, depending on when you were able to grab it. This is fantastic. Stress-free trading. You don't have to worry about it, right? It's already stress-free. Cart is another one that came out in our newsletter about 2 weeks ago. We got the big breakout here. These are up 200 to 300%, depending on where you grab them. This is what I was talking about in the small and mid-cap space. This is a mid-cap name, 9.53. Recent IPO high breakout. It's a super easy trade idea, right? Just buy the range high breakout. But this is particularly what we're finding on our scans right now with IWM breaking out. So if you're running some scans, you're looking for some small mid-cap names, this is the type of stuff that you're looking for. These are fantastic setups. I'm not telling you that you're going to make $1 billion trading these, but once again, you know exactly where you're wrong. Above 28.5, it's go time. Below 28.5, maybe you got faked out. It's very simple. You're not reinventing the wheel. There's no overhead supply, etc. We got a bunch of these things. Vimeo is another one that we're in. Was having a great day as well. Look, you know exactly where you're right. 475. Below it, you're probably wrong. This is super easy. AVDX, another name that we're in right now. Once again, super easy. You guys see the theme here. Above 12.5, probably should be long. Below 12.5, maybe you're not in the right name. Super easy. The market is giving us layups. You don't need to go and find the absolute hardest trade in the world, like Shaq here. Shaq is, a harder trade that we took. This went out in the newsletter as well. So if you're in this, good job. It's up and over 100% today. So this should be flipping free, close half, stress-free trading, right? This is our COD setup off of an EP episodal pivot. This is a power earnings gap related episodal pivot. Whatever happened for Shake Shack, the market absolutely loved it, gapped it up. We bought the range high breakout after it consolidated for a few days, and this is now up and over 100% for us. We have a price target at 120, and because we're in straight calls, we have an opportunity to hold this if it gets up there into all-time highs, which is fantastic. So this is a stress-free, risk-free trade at this point. Good job if you're able to grab it. Last one I want to go through really quick is App. 2-year highs. This was a challenging trade, if I will, but now it's up 400 to 450% for us inside of TTI. We did put this out on FinTwit. I don't think it went out on the newsletter, so I apologize if you're watching this and you're only on the newsletter. Please go follow the Twitter. I post there like 5 to 6 times per day, trade ideas, trade updates, just general banter. It's at How to Swing Trade. Go follow me on Twitter. It's fantastic content, I promise. To Your High app. Big win for us. Good job. Once again, this is one of those super easy to read charts. Split the chart in half above 45. You're probably more bullish than bearish. There's not a lot of overhead supply that you have to worry about. It's a tech software name. We were just talking about this, and when we bought it, it was about a $15 billion market cap, which is right on the fringe of a mid cap at this point. So once again, we counted this as a mid cap related play, and it ended up working out well for us. The last one I want to talk about is our ad on Solana. Hello. It's the Solana ad. This just went out in a newsletter. We wanted to, this is the third entry on Solana. We originally grabbed it like the $40 area. We grabbed it again at the $62 area, and we grabbed it again right here at the 117 breakout. I do want to point out that we're up, congratulations, but we're not up enough to move the stops, right? We want to give this thing wiggle room. Solana is a volatile asset at 6.37% ADR, meaning this thing moves a lot intraday. The worst thing that could happen is if we get into a fantastic position and then we get something called a whipsaw, which is where price action just immediately comes back, stops us out, and then bounces into new highs. We don't want that to happen, and it notoriously happens in crypto. So what we want to do here is we want to wait for a 2.5 or 3x ADR move off of the entry, which in this case, let's say you grabbed near 117 with a 6.37 ADR. We're looking for like an 18 to 20-ish% move, somewhere near 140. So if Solana gets up to 140, closes the daily candlestick, move your stop up to break even. Now you have a break even stress-free trade on Solana, and you can let this thing continue to run. And by the way, we're betting for an all-time high breakout in Solana, along with Ethereum and along with Bitcoin, up near 250. That's our price target off the 117. So this is an incredibly high risk to reward trade, and we're giving it room to breathe, right? So let's talk big picture really quick. The February drawdown didn't happen. Took some minor losses on half of the shorts we took as hedges. Managed to make some money on the shorts. On some of the shorts we took as hedges. I think JKS was a good short that we grabbed money on. MOS was a good short we grabbed money on. We lost money on the Chewy short. We lost some money on LPG. Break even on the Qs. I think I'm missing a couple. But all in all, it was an okay tranche of positions. We were focused on potentially capturing some downside weakness that seasonally was coming through. We saw it coming through on some intermarket relationships. It just didn't manifest itself, which is fine. The losses did not add up to anything substantial on the overall portfolio. So if you were a part of that, congratulations for not blowing a port, going short in an uptrend. But now you have some experience kind of prepping for a full pullback that doesn't happen. You have to be able to switch your bias back to long, which, it never really should have stopped being long just because you're prepping for a potential pullback. This is a bull market, baby. 2 years, fourth year of a presidential election cycle is incredibly bullish. We're in a secular bull market. We're on the precipice of an AI bubble. There's no reason to expect this market to burst anytime soon. Guys, remain long until technical stops get hit. Remain long until technical stops get hit. Do not try to time the top, guys. Do not try to time the top. The guys that are underperforming the most right now are not day traders. They're not day traders. They're not scalpers. They're swing traders that are trying to time every single local top and buy back every single pullback, because if you time a top and then the next day the stock gaps up, you're out. You're done. You don't get to buy that trade anymore. You're going to go and you're going to have to find something else. And if you were already focused on market leaders to begin with, that means you are out of some of the biggest statistical winners of the year, and you're out of them early. I implore you guys to hold your market leading trades longer than you reasonably expect unless they get stopped out on a technical basis. The worst time to try to call a top is in a runaway market, guys. And right now, as if I have to prove it to you, we are in a runaway market. Don't close the goddamn trades. Guys, on Monday, we have a monthly charting session that we're holding. We build out the entire framework for our March trades inside of the trading initiative. We cover the most important charts on the weekly, monthly, and daily time frame. We include all of the indexes, intermarket relationships, strong sectors, industry trends. We look at trade ideas. We update our trades, etc. It's normally reserved just for TTI members, but I think what we're going to do here is I'm going to open it up for like a $99 one-time fee for anybody here that wants to attend. It will give you an opportunity to see exactly how we operate on the market research / trader development side. It's a one-time fee, so you're not going to have to worry about being charged, and it's low enough to where if you want to see how we operate, you're going to be able to, right? It's a 1-hour session. You're going to be able to walk away with some incredible insights and some trade ideas that you're going to be able to put on the books this month, right? So you're going to take the same trades that we talk, and you're going to get the same inside scoop. that we give all of our members, right? So it's not going to be recorded. It's not going to be resold. It's going to be a one-time thing on Monday, 7 p.m. Eastern Standard Time. I'm going to go ahead and send out some links this weekend via the newsletter. If you're on the newsletter, watch out for those to sign up for it if you're interested. If you're not, listen, that's okay. I'm not offended by it. I'm glad you're just here at the end of this video listening to me ramble on, right? So if you like it, feel free. I'll see you on Monday. If not, that's okay as well. Guys, my name is Hamilton. I'm here at the Trading Initiative. This is this week's Markets in Focus. If you like this type of content, please like and subscribe. Leave a comment below. Let me know what you think. AI bubble? Are you trading it? Let me know. Catch you in the next one.